So why would anyone want to invest passively and pay someone to manage their real estate investments when they could just buy a property themselves? Well, first of all, it gives you access to higher quality investments. Suppose you had $100,000 to invest and you wanted to purchase a small investment property here in Chicago or another big city. For that kind of investment, you should be prepared to get a property that's in need of some major rehab and is probably in a marginal neighborhood. Now, these type of deals can be quite profitable for the right investor, but be prepared, it's going to be very labor intensive. Now, investing passively with a developer or a syndicator to manage your investment for you, it can offer the opportunity to invest in larger and higher quality deals, which are often out of reach for an individual investor. And this can mean higher risk-adjusted returns with a lot less headaches. Now, secondly, it's going to limit your liability. Buying even a smaller property means signing for a loan and a lot of personal liability. So as a passive real estate investor, you don't have to deal with all the personal liability that goes along with it. You can leave all the bank negotiations and legal work to your sponsor's professional team. Number three, it's easier and you're more likely to diversify because you're part of a group of investors and you don't need to borrow money yourself for each deal. It's much easier to diversify and split your investments between several projects. For example, you might invest in one project that's a new development or a major value add deal, has a lot of growth potential, and they plan to build out a property and sell it for profit, right? You might roll those profits into another deal that's geared towards long-term cash flow. And that can offer you bonus depreciation to offset your capital gains and save taxes. Number four, you're going to have a skilled professional team working for you. Now, successful entrepreneurs and business people know that in order to grow a great business, you've got to grow a great team. And people who think they're saving money by trying to do everything themselves, they seldom find success these days. Smart investors invest passively to leverage team expertise and tap into the knowledge of experienced professionals. Number five is that this is the way to get truly passive income. Purchasing, owning, and operating income properties yourself takes a lot of work and a lot of expertise, and there's nothing passive about it. But when you invest passively in a real estate syndication or partnership, you can enjoy a truly hands-off experience. You'll receive your proportionate share of profits as totally passive income, and you entirely avoid dealing with lenders, contractors, vendors, or tenants. Number six, you're going to have Uncle Sam working for you. So when you invest passively, your proportionate share of passive losses and depreciation, bonus depreciation, they pass through to you annually on your K1. And that means you keep more of your earnings. And number seven, it's much easier to invest with retirement funds. If you set up a self-directed IRA or 401k for yourself, investing passively as an equity partner in a syndication or LLC can be as easy as just writing a check. It really comes down to a matter of mindset. These days, even a simple deal takes a lot of capital and has a lot of moving parts that demand a lot of specialized attention. And if you plan to make real estate your full-time profession, then building your chops with active investing may be the way for you to go. But if you have a great career, or maybe you already own a successful business, chances are that you're going to be far better off to find a real estate developer or syndicator whose market niche resonates with you and invest with them and grow your equity along with them and their team.